Heineken is still massively down from its all-time highs, generating 3.3 billion in free cash flow and growing revenues. So let's look into it. First of all, growth has been slow. Now Q1 was extra hard because the euro just appreciated a lot, but we can see 2.4% decline in volume. But because they sold more premium brands, they still made more revenue than before. But when we look into their deeper markets, their already established markets, America and Europe, here they also had a price mix increase, but not as much. The volume decline was so big here that it was not able to be compensated, so they actually shrank. Now when it comes to Africa, Middle East and Asia, they massively grew here. Of course, those are newly tapped markets, especially Africa. Wages are rising fast here, so even if beer volume doesn't go up as fast, they can easily switch to a pricier version. Most of the stuff that is sold is on the bottom of a tier, so they have a lot of room here by just introducing premium mixes with a bit of volume growth. However, what I am concerned about is this volume decline in Europe and America. We just drink less. When we look at annual consumption of alcohol, while it is overall flat since the 2000s, slightly growing, beer has heavily declined. Meanwhile, spirits and wine have risen. So they're in kind of a shrinking segment here, and they expect it to continue to grow at 0%. Now they're saying, when it comes to value, they can get more out of the premium beers. Question is, you can only introduce customers to higher and higher brands for some time. Eventually they won't buy a 50 euro beer. And while they're in very many categories, also in cider, seltzer, while they're expanding into these categories, mostly through acquisitions, beer is still their core product, and this is where the cash flow comes from. So for Heineken, in the long term, to be profitable, the beer market needs to stabilize. And I think it is gonna stabilize. Because beer is a stable, it has always been there, it's not gonna disappear. It may have lost market share, but it's gonna stabilize. So if we then kinda assume that for the next few years they're gonna grow slightly, while the volumes might slightly decline, or rather stabilize from now on, they're gonna increase margins a bit through more premium brands. What can we expect from the business? 30 to 40% payout ratio. So a nice dividend and acquisitions. Because if you just assume the 3.3 billion in free cash flow is just there, that they can spend it however they want, this is not pure free cash flow. The revenue growth has to be generated through acquisitions partially. We can see they do a big acquisition every few years. Now it is not extreme, it's not like they spend 1 billion every year, plus when it comes to intangibles, they also buy a lot here. Let's assume that we have 2.5 billion in free cash flow that is spendable each year on average, growing. Around half of it goes into the dividend. So they have 1.3 billion for share buybacks. Now currently they're spending only 1.5 billion over the next 2 years, but I think they're gonna ramp that up soon, unless they do some huge acquisitions over the next 2 years, which would in turn probably boost revenue growth. So we get around a 3% buyback yield, a 2.4% dividend yield, and the company grows revenues by around 4% each year, but they also have a bit higher margin growth just because they're selling more high quality products over time. The debt load is also not too high, the free cash flow supports that very well, so overall a very conservative business that we have over here. So we have a solid company, number 1 in premium beer, number 1 in non-alcoholic beer, number 1 in cider, spirit beer, and if they can translate this success into the Africa region, where volume is growing fast still. And I think that will more than offset the Europe and America decline. So that's the question. We have stability. Are we paying a premium for this stability? What are our assumptions? Overall, if we go off the 2.5 billion in distributable free cash flow, that would be 4.4 per share. What are our growth rates? Now we're gonna do around 2.5% in buybacks probably. America and Europe are kind of stable. They're gonna have growth from Africa especially, some growth from Asia. That together with the acquisitions, I think they can do around 6%. Not fastly growing, but solidly growing the core business, plus a few acquisitions should do the trick. Slight slowdown afterwards. 60 multiple, slightly higher than I normally put, but it's just a very steady brand, very reliable dividend payer. So I don't really see why this should be valued lower. Then we come to 67 euros a share, 14% where it is trading below. So we pay a very high premium for that stability. We would get around an 8% return right now. Not bad at all, but also not very great. And that's the price you pay in this case for quality. Now if it grows just a tiny bit faster, 10% and 8%, let's say Europe and America just reaccelerate slightly, to go for an 80 multiple, we would make a decent return. However, the downside is, let's say the African economies deteriorate. We basically only get tiny growth from Asia, the buybacks, stagnating Europe and America. 4% and 3% afterwards, 13 multiple, $44 a share. So the downside is there. The downside is most certainly there, but I don't really see the upside in this stock. As much as I like quality, I think you can get quality at a decent price. So Heineken, interesting stock, but nowhere near levels where I would be interested in. I'm putting this aside. What do you think? Right down below. Have a good day.